As of this moment in live trading, shares of Connexa Sports Technologies, trading under the ticker CNXA, are in absolute freefall. The stock is currently priced at $0.18, a catastrophic drop of $2.33, representing a staggering 92.83% loss in a single session. This isn't a market correction, it is a complete and utter collapse. For anyone holding this stock, this is the nightmare scenario. And while a drop this severe is shocking, it's not surprising. This wasn't a sudden, unforeseen event. This was the final, brutal confirmation that the market has completely lost faith in this company's ability to continue as a going concern. The expectation of a potential turnaround, fueled by a compelling product idea, has just collided with the harsh reality of a business that has been bleeding cash and plagued by operational failures for years. The prevailing narrative for Connexa Sports, especially for its flagship Slinger Bag product, was that of a small company with a clever idea that could capture a niche in the massive global sports market. Investors, particularly those looking for speculative, high-growth opportunities on platforms like the Robinhood app or through SoFi Invest, were drawn to the story. The expectation was that a product like the Slinger Bag, an affordable, portable tennis ball launcher, could democratize tennis training. This hope was bolstered by acquisitions of other sports tech companies like PlaySite and GameFace.ai. The belief was that by rolling up these small tech players, Connexa could build an integrated ecosystem of connected sports technology, a story that sounds compelling in a pitch deck. Traders saw a stock trading for a few dollars and dreamed of it becoming the next big thing, perhaps foolishly comparing its potential to the established growth trajectories of giants like Tesla stock or Apple stock. But the reality of the situation has been a slow-motion train wreck, culminating in today's implosion. This 92% drop is the market's response to a long history of financial distress, questionable strategic pivots, and a desperate struggle to simply remain listed on the NASDAQ. For months, even years, the warning signs were flashing bright red for anyone willing to look past the hype. The company has been in a perpetual battle with NASDAQ's listing requirements, primarily the $1 minimum bid price rule. To combat this, management has resorted to multiple reverse stock splits, including a 1-for-20 split in June 2024 and a 1-for-40 split before that. These are not signs of a healthy, growing company. A reverse stock split is financial engineering designed to artificially inflate a stock's price to avoid delisting. It's a cosmetic fix that does nothing to address the underlying business problems. For seasoned investors, perhaps those using the advanced charting tools on Interactive Brokers or consulting with Fidelity Wealth Management, these repeated splits were a clear signal of deep-seated trouble. Each split effectively wiped out a huge percentage of shareholder value for anyone who held through the event, and today's collapse is simply the final chapter in that story of value destruction. This company's financial health has been deteriorating rapidly. Public filings show a consistent pattern of negative cash flow and mounting losses. While the company holds some assets, its liabilities and cash burn rate created a situation where it was constantly in need of fresh capital just to keep the lights on. This led to highly dilutive security offerings, where the company would sell massive amounts of new stock and warrants at rock-bottom prices, flooding the market and crushing the value of existing shares. An investment in Connexa wasn't a stake in a growing business, it became a contribution to a fund that was being rapidly depleted by operational expenses with no clear path to profitability. This is a classic trap in the world of microcap stocks, where the promise of innovation is used to mask a fundamentally unsustainable business model. Investors in their individual brokerage accounts at places like Fidelity or Schwab Intelligent Portfolios, who prioritize fundamentals, would have seen these dilutive offerings and the negative operating cash flow as immediate disqualifiers. What does Connexa Sports actually do? At its core, it was a holding company for several sports-related brands. The most well-known was Slinger Bag, the portable tennis ball launcher. They also owned PlaySite Interactive, a company focused on video and analytics for sports like tennis and basketball, and GameFace.ai, which was meant to bring AI-driven analysis to athletes. On paper, these pieces seem to fit together. The expectation was synergy: sell a Slinger Bag, then upsell a PlaySite subscription for performance analysis. The reality was a fragmented operation with products that, while interesting, never achieved the market penetration or recurring revenue to support the costs of a publicly traded company. More recently, in what appears to be a desperate pivot, the company has become entangled with UUM Enterprise Management, a company described as operating in the love and marriage sector, and has made announcements about launching a cryptocurrency exchange for real-world assets. This dramatic shift away from its core sports technology mission was likely the final straw for many investors, signaling that the original business plan had failed and the company is now grasping at straws in completely unrelated speculative ventures. Comment below if you've ever invested in a company that made a sudden, bizarre pivot into a completely different industry. How did that turn out? The future outlook for Connexa Sports Technologies is now exceedingly bleak. A 92% single-day wipeout following years of decline typically leads to one of two outcomes: delisting or bankruptcy. The stock will almost certainly be delisted from the NASDAQ, relegated to the OT markets or pink sheets. When this happens, liquidity dries up almost completely. Large institutional funds and brokerage platforms like Fidelity Investments often have rules preventing them from holding such stocks. It becomes incredibly difficult to sell any remaining shares, and the stock often drifts towards zero. For common shareholders, the chance of recovering any significant portion of their capital is practically non-existent. In a bankruptcy scenario, shareholders are last in line to be paid, after creditors, bondholders, and everyone else. Given the company's financial state, it's highly probable that there will be nothing left for them. This is the stark difference between investing in a speculative microcap and a blue-chip company like Nvidia stock. The latter has a fortress balance sheet and a dominant market position, providing a floor for the investment, while the former has no safety net whatsoever. In the end, the story of Connexa Sports is a cautionary tale. It demonstrates the immense gulf that can exist between a compelling product idea and a viable business. The expectation was a fun, accessible sports technology product that would conquer the world. The reality was a business crushed by poor financial management, a lack of execution, and a series of desperate maneuvers that only delayed the inevitable. It serves as a brutal reminder that a low stock price doesn't mean a stock is cheap, and that the allure of finding the next big thing on trading platforms like Robinhood or SoFi Active Investing can lead to a near total loss of capital if not balanced with rigorous due diligence. The market has delivered its final verdict on Connexa, and it was swift and merciless. The dream of a connected sports empire is over, erased in a single devastating trading session. The content shared here is for educational purposes only and should not be considered financial advice. Always consult with a qualified financial advisor before making any investment decisions. If you found this helpful, please like, comment, and share to support the community.